Jeff, it's great to be here in Palm Beach and to get you onto Real Vision. Just chatting off camera, we've got a lot of friends in common we didn't realise.
Yes.
You've got a fascinating story, and I think people would love to hear the story of how you started your career, how you got into real estate, but even starting before then, you as a student going to university. Talk us through a bit about that.
Well, I don't know where to begin. I was born in Worcester, Massachusetts, which is a city about 40 miles from Boston. My dad was a textile machinery dealer, which meant, you sold these giant machines that were longer than this room. They could be 100 feet long to mills and parts that also, and they did very well. We were a middle-class family, had a nice cute little house with a backyard, and my mom was pretty much a stay-at-home mom. And then in the late 60s, all the textile mills got unionized in New England, and they moved to the South. And my dad lost his livelihood because he didn't know mills to call on. But that's all he'd done. He had all this money in his business. He had a warehouse with parts and materials. And so my parents picked up and moved to West Palm Beach, actually. And my dad bought a small rubber stamp business. He never really got on his feet again. And it was, for me, I was just a junior in high school when they moved here, but I was really still in junior high school when our financial fortunes went the wrong way. And so I had to work my way through college, and I had some financial struggles, which probably made me hungrier than ever to do well.
And how did you pay your way through university? There's a bit of a story about that, because you went to Harvard, didn't you?
Well, I went to college at Johns Hopkins University in Baltimore. So it's interesting. I applied for scholarships, and I got scholarships and student loans. And then so that paid some of my costs. And then I had been an exchange student in Israel in high school.
Right.
So I learned to speak Hebrew fluently. So I taught Hebrew school 3 days a week. I had to ride the bus in Baltimore. I had to change two transfers, so 3 bus rides to go out there to teach Hebrew school on Tuesday and Thursday. Then I rode out with another Hopkins student on Sunday. Then I had another job where I checked IDs outside the gym. It was called Work Study. It was a government-funded program where you get paid $1.50 an hour, and you're supposed to be able to do your studying while you check the IDs, which you do. And then I also, when I came down here to visit my parents, I worked at the Breakers Hotel here in Palm Beach.
Right.
I was a busboy and then a waiter in the main dining room. And I just, kind of slogged along and made it through college. I finished Johns Hopkins in 2.5 years. Not because I was such a genius. I think it was because I was working so hard. It wasn't really a fun college for me.
And then after that, where did your career go?
Well, so then what happened is I was down here one summer in West Palm Beach. I was working at the Breakers, not making any money, because who's here in the summer? Nobody, so no tips. So I saw an ad in the local paper. It said telephone sales. And I went to answer the ad. It was to sell circus tickets for the local Riviera Beach Fraternal Order of Police, which is a nonprofit, police organization. And it said $2.50 an hour or commission. Well, minimum wage was $1.60 in 1973.
Sounds
so
good.
$2.50 an hour, you can make $100 a week. Tuition at Johns Hopkins in those days was $2,700 a year. So if I can make, work for 12 weeks, I'll make $1,200. Not so bad. I start selling these tickets. I'm noticing I'm selling more than everyone else. I feel like I'm selling more than everyone else in the room. So I said to the guy at the end of the day, how much would I have made on commission? He said, $93. I said, well, I'll take commission. Instead of making $20, I made $93. Anyway, I ended up doing this all through college. Wherever I had a break, I then would go on the road and run a telemarketing office for the circus. After I finished at Hopkins, I went on the road to run these telemarketing operations for a fundraising circus from Sarasota, Florida. And I would roll into little towns all around the country, like Bluefield, West Virginia, towns you never would have heard of, towns of 20,000, 30,000. I'd go, I'd roll, but then I had a Pontiac Grand Am. I had my clothes on a bar across the back seat, laundry detergent in the trunk to go to the laundromat. And I would roll into town, check into the Motel 6 or the Days Inn or whatever it was. And I'd set up an office, sell the circus tickets, hire local people. And I did this. It was a lonely life. I finished college before I turned 20. So I was just 20 years old,
wow.
21, 22, all by myself like a traveling salesman in these little towns. Forget having a girlfriend. You couldn't even have friends because you're always seeing different people. You're always on the move. So I did this, and I saved up, and I worked so hard, I saved up $100,000 in the mid-'70s.
Really?
And it was just from working, I worked nonstop. I lived on nothing. I saved every penny because I was determined after what I'd been through, working my way through college, never to be broke again.
And seeing your dad as well go through the cycle.
Saw my dad actually, it's worse than not losing his livelihood. He actually lost his life. I mean, when I finished Harvard Business School in 1979, in May, my dad didn't make graduation because he was having heart issues. He died 2 months later of a massive heart attack at the age of 51.
Wow.
And I really believe it was because of the stress of, not just losing his livelihood, but losing his dignity and his sense of worth.
Sure.
And it puts me in touch today very much, and that's probably one of the reasons I've gotten involved so much in philanthropically and politically, because I've really saw firsthand how somebody can get broken when their economic reality changes. But anyway, so I saved up all this money, go back to Harvard Business School. I had $100,000 in the bank. Never had bought any real estate because how could I? I was in a different city every 2 weeks.
Yeah, you were living out of a car.
Sorry?
You were living out of a car.
More or less. I mean, I did have stuff stored. I'd never had an apartment. I had stuff stored at my parents' house, my aunt's house. I was living out of my car more. I mean, when people say that, you think I wasn't sleeping in my car, but that was my base.
Yeah.
My Pontiac Grand Am. So now, and a lot of people I knew had invested in real estate. So it's interesting. I got into Harvard Business School. I didn't get into the good housing complex, Soldiers Field Apartments, because there was a waiting list. So a friend of mine from Hopkins said, who had started Harvard Business School, I said, what do I do? And he said, well, what you can do is, why don't you go buy one of these three-deckers. What's that? It's like a three-family house built in the late 1800s. You can live in one, rent out the other two, and at the end of the time, you'll probably be able to sell and get your money back and live rent-free. I'm saying, well, that's interesting. So I called up, I was sent by to this guy's friend who was a broker, who had also been to the business school, and who I still know actually. And I bought a three-decker and lived in one. And the market was so undervalued in 1977 when I bought this. I could see, I was saying, I bought it for $37,000 with $7,000 down. So then what happened is I got approved for the housing. I was thinking, well, gee, maybe if I rent all three, how is this investment going to work? And by every measure I looked at, I was going to end up, after my mortgage payment, making $2,200 a year on my $7,000 investment. So I think that's 30% return. I said, I got to get more of these. So while I'm at Harvard Business School, I accumulated 18 properties. I mean, I bought them.
And you were just buying them out of the cash flow of each property?
No, I had my $100,000.
Oh, of course, yeah.
So first, the first one I wanted to get one that was perfect. So I'm saying I can't be like dealing with repairs when I'm at Harvard Business School. Who's going to do this work? And then I started getting comfortable doing remodeling. And by the time I was done, I was buying junky buildings, fixing them up, and anyway, that became the beginning of my real estate career. And as it turns out, the market was so undervalued. That property I bought for $37,000, I sold 3 years later for $185,000. Another property I bought for $38,000, right near the Cambridge line in summer, I sold it for $380 to $380.
So is that when interest rates started coming down that suddenly the price of property exploded? Around 81, 82?
I think you're right. I can't. Yeah, that's when Reagan was just. Yes,
yeah, that's
exactly.
right. Reagan had just got in. There was the Reagan-Thatcher years. Interest rates had just peaked and were starting to come down.
Right, in the late 70s. So they were, so for whatever it was, the market just exploded. And my $100,000, by the time I finished Harvard Business School, I had $1 million net worth. And then, I was off to the races. It's interesting because people often...
So you didn't use your Harvard education at all? You just went straight
Not at
into
that
real
point.
estate?
Well, at that point, I always use my Harvard education. But.
So you leave Harvard, you've made your $1 million, and I guess you decide real estate's the business you want to be in.
I sort of fell into it, and so what happened is I decided to move to California. I had a great aunt and some cousins there, so I moved to LA after I finished at the business school, and thought I'd do real estate. But the prices in LA were very different than they were in Boston. Boston was it was before the the tech booms and the biotech booms. I mean, Boston was a little bit sleepy in the early '80s. Yeah, slow growth. So you could even after things had started to appreciate, you could still put down, when you buy an apartment building, you put down 20, 30%, you'd make a nice return on your cash flow, 5, 10%. I go to LA and you buy a building and say, okay, here's what you do. You put 30% down and you'll lose cash flow. Because basically in LA you were buying the future, so because everything was perceived to be going like that. And I just didn't get it. So I did some other things. I bought actually 50% of a clothing manufacturing company. Did that for 14 months.
Why?
I just finished Harvard Business School. I had to do something for my career.
Right.
I looked at buildings, they all just seemed outrageously expensive. It didn't fit the formula. I was used to cash flow real estate. I just couldn't figure it out. So, I think to tell you the truth, I had taken a class at business school by a small business. And they said the way you find a small business is either business brokers or go talk to local accountants. Well, my cousin was a textile salesman. So I said, let me go see your accountant. The only companies the accountant knows is textile and garment companies. So he said, well, I got this guy who has he has a company, his partner, spotted his partner, he's looking for, someone like you to come in and help run the business. And so I bought half of this company, and it was a very successful 14 months. I hated every minute of it. It wasn't my kind of cup of tea. I mean, truthfully, I'm showing up in my, at the time, Brooks Brothers suits and button-down shirts and ties, and these guys who are working, they have, gold chains around the necks, and they're wearing these rayon printed shirts that, it was aggressive, tough, screaming and yelling, and it wasn't what I was planning on doing with my newly minted Harvard MBA. So, but anyway, I got out, made some money, and then I started doing real estate deals, and started buying. I figured out the LA market, started buying properties, and had a nice run up till early 90s when I participated in the crash like most developers and investors.
So when you said you kind of figured out LA property market, does that mean you just went into the momentum trade and realized it was all about price gains and not about...
Yeah, I realized that you're not going to make your cash flow year one, you'll get your cash flow in year 3 or 4. That's how it was priced, and so I started doing things that way. And sure enough, I bought one or two, I bought like an 8-unit building, then 7-unit building. And then you seeing there, as the rents go up, and I start saying, now I get this. And so by the time I get to look from, that was starting like in 82, 83, and by 91, 92, 93, I had about $100 million real estate portfolio. I never had investors or partners, but I had a lot of debt. That's how I built it. And I probably had debt on it of maybe, I don't know, 65 million, which, so 35% equity. Had been refinancing to grow aggressively. And then the market dropped, and all of a sudden, some of these
1991,
92, 93, 94. By 94, my $35 million net worth was like minus $15 million.
So did that debt terrify you? How did you think about debt from then?
It was tough because, basically from my paper routes and snow shoveling jobs, my whole life in business had been straight up. I mean, and the truth is, let's, finish Harvard Business School at 24, I have $1 million. I mean, I'm thinking I'm a genius, I'm boy, and people call you must be, you're a boy wonder. You think I'm really a smart guy. And basically, it's interesting, I had not been married. I had girlfriends, but I'd been single. All I really had was my career, to tell you the truth, to hang my hat on. In 1994, I was just turning 40 years old. And basically, everything I'd worked for was all of a sudden that, and it was tremendous. It was a tough few years. It was a tough few years because I'm thinking like I could actually very easily be liquidated out and back to zero and have nothing at all to show for all what I've been doing my whole career. That I had good education, but where would it have gotten me?
How did that affect you psychologically at the time?
It's tough. I mean, it's interesting.
You can't take risks so easily when you're thinking like that.
It's interesting. I mean, I've always been believed in the fundamentals, like the way I invest, the way I do everything, and I try to focus on long-term and not let noise bother me. I knew why that market had happened. I understood it very clearly. It was it's a longer story, but the government empowered savings and loans and then allowed them to make crazy loans. And so basically, because what happened, if you remember back, interest rates started going up. Mm-hmm. S&L has had on their books all these fixed rate loans, and they were all in trouble. So the government said, okay, you want to be able to pay 8% for CDs, we'll let you do anything. And so people were buying McDonald's franchise with the S&L funds, and they were making 100% construction loans. And so, of course, you're going to have this crazy froth in the market. So I didn't really feel like that nothing that I had done. It was the government that did it, and it happened. And so I plodded through it. I kept renegotiating with lenders. Lucky for me, I had one main lender. It's called Glendale Federal Savings. They were the 6th largest S&L in the country. And believe it or not,
they stayed solvent.
Barely.
Right.
They had $200 million in capital, and I owed them like 60, I owed them 50 million, like everything.
Oh,
I
okay,
owed.
so you were too big to fail.
Crazy, because they were like almost a $20 billion SNL, and my little thing was enough to push them over the top. So they kept working with me, and I was, look, I was very persistent. I mean, I'd give them a building, they would cut loans on other buildings. We just worked together and kept restructuring a few times. Then eventually, by probably 95, 96, my net worth was zero again, like all my loans equaled my values. And then I got lucky, and I sold one property. I had a property on Sunset Boulevard, a nice town in Brentwood, a nice part of LA, 40-unit building. It probably was worth $4 million. The loan was $4 million, but the Getty Museum needed housing for their new faculty. They were just finishing the new Getty Museum. And they had looked at some other land I had, and I called them up and I said, how about this building? And I sold it for $6 million, and so I got $2 million cash. Now, most people, having been through what I was through, would have taken that $2 million.
So thank you very much.
Said, I'm not going to risk this ever again.
No.
But I didn't. I went and I bought 3 new buildings immediately, and I bought them from the RTC. I bought an office building for $30 a foot.
So I just want to go back a little bit. How do the psychology of doing that, right? So taking a loss or getting close to having to realize a big loss, it's actually quite a hard thing to do. Trading, investing, I ran a hedge fund, I know what that's like. How did you distance yourself from that and say, right, let's do it again? Or you thought you had nothing to lose anyway?
No. I just felt that, I really felt that I understood why this had happened. And I felt that this was a crisis that was brought on by the savings and loan, excesses. And that the RTC and the government handled it very badly. I don't know if you remember it, the Resolution Trust Corporation, they just took everything and liquidated it, and they caused a lot more havoc than would have otherwise been in the market. So I could see that's why my properties were dropping in value to those levels, not because people were leaving LA or they didn't want to live there anymore. And so I have a chance now to buy these properties at, really pennies on the dollar. So I snapped up an office building for $30 a foot. That was like 8 years old. It would have cost $200 a foot to build then.
Wow.
And then I bought another, I remember a 65-unit apartment building for $2.7 million. All townhouses. And I'm thinking, there's no way you can lose money on these deals. And sure enough, they all like tripled in value. And so then I started, I was able to get those stabilizers, or we refinanced, and I just started growing and buying. And honestly, I'd say that my recovery in the late 90s was really was really relationship-oriented. I've always been very relationship-oriented.
Yeah.
And I had one bank that I worked with a lot. And, I figured out what they needed, and they figured out what they needed to do with me. And they were my lender. And I started buying properties very aggressively, at very cheap prices.
All in LA?
All in LA. I was buying apartment buildings because what you had in this SNL period, you had people who had built all these new buildings. I mean, hundreds and hundreds. If you drive to LA today, you'd still see these late 80s. They're 4 stories, because that's the zoning, over 2 levels of parking, wood frames, stucco.
Yeah.
They all look the same, And basically, these buildings, what happened is moms and pops would have them, or people would own them, and they were shell-shocked because they went through, rents, because they have a building. They maybe got it in, say, and I'm just guessing they built it maybe in, 1987, 88, 89. That's when the big building. So now this RTC gets the building next door and cuts the rents by 40%. So now you cut your rents by 40%. By the time you get to 96, you're just so happy to have tenants. No one's raising rents. Rents are way below market. You can go into buildings and just buy them, clean them up a little bit, change the entire rent roll to market, and then refinance and buy more. And so I got this going, again, through great broker relationships, lending relationships, and I got up to 8,000 units by 2005.
8,000 units?
And over $1 billion worth of real estate.
All in LA?
All in LA.
Wow. So talk me through the next phase then. So you're 2005, you've now got half of LA, so it sounds like.
It was a great run, and I'm thinking now, and my debt was probably, I'm guessing, $500 million. So I've gone from, minus 15 million to positive 500 million net worth, but I know that stuff can happen, and even things that you have nothing to do with, like the SNL crises. And I'm thinking, what had happened was, the values got so high because after the dot-com bust, interest rates were cut to the lowest since World War II. Mm-hmm. And as a result, cap rates on apartment buildings got very low. And I'm thinking, this may not be sustainable. What can I do And so throughout, as this is happening, in like in '04 or '05, I'd go and I'd sell 5 or 6 buildings, get some cash, then I'd think, I'd do an exchange or buy more buildings. And I'm thinking there's got to be some kind of hedge, because I'm reading about all the stuff on Wall Street and, And
Which year are we talking about now?
This is '06.
Right.
And there's got to be some way, rather than just selling buildings and getting nervous, then buying new ones, there's got to be some way to get a hedge. So if the value of the buildings drop, I won't lose as much money. So I go to talk to Goldman Sachs, to JP Morgan. They're saying, well, you can short the S&L stocks because if the market collapses, those will drop. And then I think, well, if you do that, what happens if one that you short gets taken over or something,
Right.
And then I went to see a very old friend of mine, John Paulson, who was, a very close friend. And, and I called him up. I said, any ideas on this? And he said, well, come see me. I'm working on something you may like. So I went to his office and he showed me how, he said, I'm shorting subprime. What does that mean? Well, I'm using derivatives. What's a derivative? Why do you use credit defaults? What's a credit default? And he shows me some slides. And I mean, I get the idea. Housing prices are not going to go up, they're going to drop, and people won't be able to pay the mortgages and the bonds will default.
Yeah.
But these are very complicated instruments. And I didn't really know exactly how you get from giving your money to putting your money up to how you make a profit, because the way these bonds worked, they were very complex. So I remember saying, I said, JP, can I do this on my own? Because we were friends, and and he said, no, you won't be able to, because you have to sign an ISDA.
That's
and,
right.
and it's an institutional trade. And so his fund wasn't ready for several months anyway. This is like in March or April of '06.
Yeah.
So I went back to LA, where I lived, and I called up all my bankers, and they told me, absolutely not, you can't do this. And I hustled, I pushed him, and then I got approved to do this trade. And initially I went short $650 million worth of subprime mortgage-backed securities with JP Morgan and Merrill Lynch. And
you then sit it out for a bit because nothing happens, it gets marked against everybody.
Yeah, a little bit. I mean, it went down a little bit. And then I went to JP, sent me his fund finally. I said, I'd like to go in your fund now. And I told him that I told him I'd done some trades, and he got upset that I'd done the trades.
Without him.
Yeah, but I still wanted to go into his fund. We're friends now, and I think it was, I probably should have been more. I should have probably told him I was doing it when I did it. In hindsight, I just didn't think. I figured he's running up. At the time, he had $5 or $6 billion in the matter. I figured he's got a big business, and I'm just doing a relatively small amount of this in the overall scheme of things. But in hindsight, I should have told him, because I think it caused a problem between us for a while. But nevertheless, so I ended up doing that. The fund dropped in the summer a little bit, and then so I was down, and then it went up, and then it went down again the next January for some reason.
And had the housing prices started tipping over at this point?
Housing prices, all the fundamentals of housing were going like this. The bonds are going like that by January. It made no sense. So I said, I want to do more of this. So I called up, and I was able to do another $400 million of the short. And so I had $1.05 billion on at that point. And I was going to do more, truthfully, but by the time I got approved for more at one of the two banks, it had already started to deteriorate. The prices already dropped again. So I had to do this, and then I just gradually started closing out that trade in, I'd say, 2008. And it was a very profitable trade. And it turns out it wasn't a hedge at all. That's the craziest thing. And I knew when I started, more time I spent on this trade, the faster I realized that this is not a hedge, because apartment building values are a function of rents and interest rates. Low interest rates provide low cap rates and stable rent markets. People want to buy buildings with stable rental markets. And so, but I knew it was an incredible trade, because I'm thinking, this doesn't make any sense. There's no way that these bonds are getting repaid. It was so that's why I stepped right up, and I did over $1 billion this time.
Well, that was a hell of an initiation into the world of derivatives, and
yeah,
so
pretty lucky.
Yeah,
it could have gone wrong,
It could have gone wrong. But there again, in the end, they're not very expensive trades. So the good thing is they were relatively cheap to put on, but the payout was so ridiculous if you get them right.
Yeah, I mean, I think I had to put up, I think, to 5%, which made sense, because basically I was doing it 1.3 over. So here's the problem. The problem with this trade, because I was very lonely doing this trade. I mean, honestly, I'd never been I'm going up against the biggest banks on Wall Street effectively. I don't know anything about this stuff. I'm thinking, am I missing something? It just all seemed too good to be true. So I would talk to my smart friends, and like one close friend from Harvard Business School and some other friends who were at Wall Street, and I'd say, what do you think of this? And they would go talk to their advisors, and interestingly enough, a lot of very smart people would come back and say, the problem is, which is really stupid, that you're basically agreeing to pay the spread for 30 years on these mortgages. So if no one pays off the loans, you'll pay for 30. But that's completely nonsensical, because even normal loans, get refinanced, and there's an average duration of any bond, any pool of loans. In this case, I focused, I don't know if you understand how these pools work.
Yeah.
So basically, there was one type of loan. It was called a 228 teaser loan. So I would try to find bonds at 80% of these. So what that meant was, for 2 years, the rate's fixed at some very low rate. Maybe it might have been at, in those days, at 6% for a subprime loan. And then month 25, it can go up 300 basis points, then 100 basis points every 6 months till it peaks at 600 basis point increase. So it means after 3.5 years, it's a good chance that these loans are going to go 6 to 12%. On top of that, a number of the loans in the pools that I shorted went from interest only to amortizing. So imagine you have a 6% interest rate loan, 3.5 years later, you're amortizing it at 12%. So of course nobody can afford. The only way out is if housing prices keep getting higher and you can refinance. But when I did this trade, only 11% of buyers in California could qualify for the medium-priced home loan. 89% couldn't qualify. So who is going to possibly push prices further up? Nobody. And that's exactly what happened.
So you get through the housing crisis pretty well. And the value of your real estate portfolio didn't really suffer? Because I guess single-family homes got really killed in that.
Yeah, my apartment, everything dropped, I'd say. Sure. But apartment rents dropped, 15, 20% in LA, and the values, the same. Think about LA, it's a very supply-constrained market. Yeah. So, even in the worst crash, it's never really that bad. It was bad in the early 90s. There was such enormous overbuilding. There wasn't any overbuilding going into 2000. Into this crash. There was no overbuilding at all of apartment buildings. No. So it was a very tight market, and of course, the economy got bad, so rents dropped a little bit.
Sure.
But it was no big deal, and then they came back immediately.
So then, after the housing crisis and the financial crisis, what opportunities did you see? Because a guy like you sounds like you would have been looking for opportunities in that.
Well, it's interesting. So what happened was, I'd never been married. I met my wife in the summer of 06. 06 was a pretty good spring summer. I did subprime short in April. I met my wife in June. It was a pretty good period. And I'd never been married. So
at Mike Tyson's party, I heard.
Mike was actually on a boat I owned in Sag Harbor for his 40th birthday.
Right.
And I'm kind of like a guy who likes to really figure things out and really plan things out, that are going to happen. I don't like depend on random circumstances. I don't go to Vegas and place bets on things. I'm really pretty, mathematical serious. So meanwhile, how do I meet my wife? I'm having a crazy party for Mike's 40th birthday, and some friends of mine go get a DJ. The DJ says, can I bring a few hot chicks, right? 3 women walk in with the DJ, and this is my mother of my 3 children. Go figure.
Amazing.
And the plans you have, they sometimes are funny. So anyway, so what happened is, so I met my wife that summer, and then summer of 06, and then we ended up getting married in September of 07, and she'd been living on the East Coast, and truthfully, I knew I was cashing out the subprime trade anyway, and I was thinking, what, I'm going to have I could save $100 million in state income tax if I live in Florida versus California. And the point is, I was only in LA 3 or 4 months a year because I was on my boat a lot, traveling. So it wasn't like I had kids in school. I was only there part-time. So I said, and I was already in Florida a month and a half a year because I'd have my boat here. So I'm thinking, let's spend a couple more months in Florida, 1 less month in LA, and I'll save $100 million. And I'm not doing anything illegal. Everybody, that's the law, So we end up moving to Florida, getting a place in Miami, and this is in early 08. And at that point, everything was a mess. But
Miami got murdered in that
But interesting enough, well, you couldn't get anything in Miami because what happened is I'd be driving around, and I've got like, I'm a real estate guy who truthfully never had any money. I mean, you don't go from 0 to 8 to $1 billion worth of real estate with no investors and no partners and have cash in the bank. You do that by, you refinance a building, 15 minutes later that money is due to buy another building. I mean, it's like literally, you get enough money to pay for lunch, but not much else. I mean, I'm cash poor, asset rich my whole life, basically, because I was always moving it around. So now all of a sudden I'm sitting with, $800 million of cash, and the real estate market is collapsed, and I'm thinking like, wow, this could really be a lot of fun, for me.
Yeah.
Instead of being like all my peers struggling, I'm just the guy with the money.
Yeah.
What a great reversal that was.
Somebody told me once, very early in my career, he said, listen, there's one piece of advice. He who has cash in a recession is king.
Yeah.
And it's so true, because then you've got the opportunity that nobody else has got.
You know what, also, it's not even, look, I didn't need to make more money. It's really more that, also it's just so much more relaxing. Having liquidity, just in general. I mean, even forgetting opportunity, just not having, it's nice to build a business and grow, and not have partners or investors to worry about, but it's stressful, constantly trying to move things around and depending on loans and refis. And so it was sort of, so in Miami, I'm there and I'm driving around because I'm a deal junkie and I'm a serial entrepreneur. I'm looking around, I see all these big buildings with all these, low lights on, and I see all these empty lots next to the big buildings. And I'm thinking, how do I get some of these? And nothing's available because it's early '08 and they just sort of, they're in the bank portfolios, nobody's sure what's happening. And so then, we moved here in December of '09 to Palm Beach. And by the time we moved here, it was just the time, I'd say like 2010s, when the property started getting sorted out. The lenders started getting control of them, and they were starting to liquidate them. So I started buying here very aggressively. I bought this hotel. I bought the note here and foreclosed on it. This hotel, I think it cost the former owner was over $100 million. And I bought the note for $41 million from UBS. And all kinds of fractured condos and land, and it was really. There's a lot of opportunities in this market. And originally, I was coming here just thinking, okay, I'm living here in Palm Beach. I'll do a few things to make some money. And I thought they're really great values. I didn't really necessarily think it was a great place to do deals. I was, a good place to do deals. But then the more time I spent here, I realized this is just a great place to live, a great place to invest, a great place to develop. And I was able to snap up all of these great opportunities.
And then the whole hedge fund industry moves here. The whole of Greenwich turns up here. I mean, that's got to have helped you, that whole tailwind of the New York taxes and the kind of big move here.
I don't think it's as big as people think. And
Really?
No, you talk to people in business. I mean, first of all, how many hedge fund people, how many do they employ? I mean, and first of all, the kinds of hedge funds that come here, little ones or an office, they have a satellite office.
Yeah, because people like Paul come here and it's just him. He trades from his office. I mean, it doesn't bring any employees down.
No, of course not, because everyone says, oh, you listen to these business development people say, we got all these hedge funds to move. People in hedge funds, first of all, if you have a hedge fund in New York City, you've got mature, serious people who have wives and parents living there and kids in school and country clubs. They're not just going to, hey guys, let's all move to Palm Beach. Okay, we'll all just quit.
It's only the founders and the owners who come down here.
Of course, it's hard to come here because they still have to keep their presence because people. It's not that people don't like. It's a great quality of life, but people have commitments. Not everybody who's going to pick up and move and uproot themselves. And you really haven't seen that. And on top of it, those aren't the kinds of companies that employ large numbers of people. Like LA. You got like Snapchat. They open an office and they employ, they have 200 people at $100,000 a year in one office. I mean, Google, when those kinds of companies come in New York, where I'm building a building, 2 blocks away, Google's building out St. John's Terminal. They're talking about 6,500 jobs, and I read the average pay it's over $100,000. I mean, that's what moves an economy. Here, we haven't really seen that.
So talk to me about the New York real estate market, because I've been talking to a few people, and just, the Real Vision offices are in New York, and I'm there every 2 weeks. And that has been one of the largest build-ups of New York real estate, I think, in history, has gone on in the last 4 years. What are you thinking about all of that? Where's your radar?
Thinking that, I wish I had done the deal I'm doing, but I mean, I'm just finishing a 25-story building. It's When I started doing it, it seemed like a great idea. Look, the problem with real estate developers is one developer has a successful building, and it does really well, and then there's no regulation on how many others can do it. So then 15 other developers or 100 that do the same building and everyone thinks, well, I've got a better architect, I've got a better view, I'm a smarter developer. Then you end up with 20 buildings, and there really were enough buyers for just the first one. And I think in New York that sort of happened. For me, I mean, look, I don't use construction loans. I don't have investors. I don't have EB-5 money. I don't have limited partners. So I try to just do enough, the kind of development that I can afford to pay for with my own cash flow. And I'll make it through the cycle. But I think it could be a long cycle. The good thing about the building I'm building, I mean, lucky for me, is it's in an area called Hudson Square, which is not Hudson Yards, but Hudson Square, which is a tiny pocket south of just below the West Village, above Tribeca, between Soho and the river. So it's really a 5-minute walk to the West Village, Tribeca, Soho, or the river. And that was great because you're kind of in the middle of everything. But what's even greater is ABC Disney is building right now the whole operation 1 block from my building on the same street. It'll be ready in a few years. And then Google's building St. John's Terminal 2 blocks away. So we're going to have 15,000 new jobs within two blocks. And that's very lucky. And I think that I have to figure out how I'm going to make it till when we're done in about 6 months till 3 years from now, when the neighborhood really comes into its own. But New York's gonna, look, you know what, you can't bet against New York, because even as bad as it is, just those 2 projects that I'm in my neighborhood are gonna have 15,000 jobs. Now I realize the ABC people were working up in the Upper West Side, and those buildings, Silverstein bought them, and they're gonna rebuild them into something. So New York is, New York is, look, it's the greatest city in the world. It's our biggest city. If you want to do certain things, you want the talent and the resource, you want the infrastructure, that's where you're going to go. So eventually, we'll figure out a way to get past this cycle, I'm sure, and all this real estate will do just fine.
So how are you thinking of the real estate market overall now? I know you're mainly focused here in Florida, I guess, for most of your investments, and some in New York. What are you thinking now? What's your senses? Because I mean, you had amazing timing in 2006, 7.
Well, I mean, look, I think there's different kinds of real estate, obviously. So, like right now, I'm building a 300,000 industrial building here in West Palm Beach, and I feel very positive about that because the movement is clearly towards more industrial, because everybody's ordering on their computers and getting things delivered by Walmart or Amazon. So there's tremendous demand for industrial space.
Yeah.
So it depends on the category. I would say that the values of things like apartment buildings that are in the 3 to 4 cap rates, and based on rents, which have already gone up for the most part a lot, seem pretty high. I mean, it feels like we're in an asset bubble in almost every category, to be honest with you. I mean, I think stocks are at an all-time high. Bonds, low interest rates are low. Those are all close to a high. Real estate's close to a high. And and it's interesting, everyone that seems to be very optimistic. I just had lunch with someone today from Merrill Lynch who was telling me how he thinks all the smart people there are just going to be fine because rates are low. And when everybody thinks things are going to be fine, that means everybody's already in, and maybe they're not going to be so fine.
That's one of the things that struck me about Noam Gottesman, that we were talking about before. Noam, he's kind of had a sense of some of this, and I mean, he went out of the hedge fund business and a lot of real estate, and he ends up buying fast food businesses and frozen food. So he bought huge chain of Burger King. He built the largest frozen foods business in Europe, just looking for that kind of anti-cyclical, smooth thing. And it feels like it's the time to be cautious when nobody else is.
Yeah, but interestingly, now the other side of this, everybody's been saying that now for a long time.
Yeah, it's been going on.
People are sitting on a lot of liquidity today, and the liquidity, though, is coming from this, you've had a rigged economy for 10 years, where basically with artificial, you have the central bank balance sheets adding, I don't know what, $15 trillion globally to their balance sheets, and you have, rates held artificially at zero for almost a decade, and now, again, very low and negative in Europe. It obviously caused distortions in the market. Now, I think everyone's used to the distortions and figures the distortions will keep on going, so everything will be just fine. But Who knows? I don't know that's going to be.
And what about the community here? Right? Because there's a lot of hedge fund managers, a lot of people, entrepreneurs who've made a lot of wealth. Is their sense starting to shift? Because there's some people I know are sensing a shift, and others are saying no, still full-on aggressive risk-taking mode. What do you think the mood is here?
Everybody talks. Everybody says you got to be cautious, but I think everybody is also thinking, I can't. Cash is trash. And we got to buy things, and that's. But look. One of my biggest holdings is Apple. It's sitting at 1.3 trillion market cap. I get it. It's no longer a device company. It's now a platform that everyone's on. It's now the telephone company of when I was a kid. Everybody has to have one, and we'll keep getting them and buying these services. But the question is, what's the value of that? Is it more than 1.3 trillion? If it's less than 1.3 trillion stabilized, then we're all going to lose money at today's stock price. I don't really, obviously, if you could show me that earnings are going to keep growing from today's levels at that company, they're going to be making, I guess they're going to have to make, $100 billion a year, to trade at 13 times earnings, which is what you'd want to be at some point, maybe not today. It's a lot of money to make, even on a global company with the monopolistic platform like the iPhone. So who knows where these things are going? It's been real estate to me. It definitely feels like there's a lot of good news already out there. Rents have gone up a lot. Unemployment rate's very low. The question is, how real is this global economy, and how much of it is it rigged? That's the question. If it's real, and sometimes you can rig things, but then the rigged economy can lead to
the
real economy.
Is does rigging last? What fragility does it build in? It's kind of like, you talked about the S&L crisis. That was kind of a rigged situation where the S&Ls were just, because of the government, irresponsible with what they're doing, right? So we're seeing the central banks irresponsible with how money's being thrown around the economy.
Well, yes and no. It's, that's the issue, and who knows? The reality is, I can tell you this, up until 2 or 3 years ago, if we had employees who in any way were substandard or giving us a hard time, you'd said, bye-bye, well, there's another one waiting right now. Starting about 2 years, probably when Trump became president, not because of Trump, I'm saying, but at that time in the cycle, the way labor market changed dramatically. All of a sudden, carpenters who were making $35 an hour are making $50 an hour, and you can't even get them. All of a sudden, in hotel workers that were making $10 an hour are $15 an hour. And wages didn't go up 3%. They went up 20, 30, 40%. And a lot, pilots, I have a plane, and my pilot salaries went up 30, 40%, just like that. So what's happened is all that liquidity has now led to increased wages. Now, if that's just starting to happen, maybe we are more mid-cycle, and then maybe we're not late cycle because
if it filters through, that is.
It is, though.
People can raise prices in the hotel or whatever.
It is filtering through because everyone's making more money, and it's Donald Trump. Lucky for him, gets to take credit for it. Whoever the president at the time. He's the custodian of the economy, and that's what seems to be happening now. I can't tell you, what are consumer debt levels? I don't know that they're necessarily overextended. A lot of people are refinancing their homes now at lower rates. Their 401ks are at an all-time high. They're going to spend money. It's going to keep this economy moving. So, what is an economy anyway? An economy is it's a perception, and so that's why people are so confused, because you look at the reality of all this, funny money, voodoo stuff going on, and you think, is it real? But then you think, in the end of the day, if everybody believes it's real and they're out spending money, it becomes real.
So outside of Apple and real estate, what do you invest in? Do you have a gold?
Well,
what do you think about gold?
I don't own gold.
You don't own gold?
No, because we have a lot of real estate, which is a hard asset. We have a nice art collection, which is a hard asset. Yeah. And Alibaba's a big position of mine. Google's a big position of mine. I tend to like that. I tend to like those tech stocks. And I have, own the banks and others too. And I have a lot of liquidity right now, to be honest with you. A big chunk of money sitting in, a lot of them in these bank preferreds that I know are going to get taken out because they're about to roll into very high spread, preferreds. Yeah. So I'm sitting on a lot of money making, 1.7 to 2%. And I'm happy with it. I'm thinking like, you know what, when things have moved, I often look at a time in the cycle and I say, is it more, if you had to make one bet, it's two choices. Are things going to be 20% higher than today or 20% lower than today, a year from now, 2 years from now? I think most smart people would say there's a better chance they'll be 20% lower because of where we are. So I'm happy to sit in more, plenty of liquidity. And you know, look, everyone's different. If I were 25 years old, maybe I'd feel different. I'm 65 years old. I'm not interested in having any trouble anymore. I've already had that in my life. So I'm basically just being cautious, and I'm ready to have the liquidity available. And if there's great opportunities, fine. If not, then I can live fine on my assets and make 2%.
So talk to me about your other interest, the institute you set up.
That was set up because 5 or 6 years ago, I could sort of see that a country that was solving in a world that was solving its problems only with monetary policy was going to leave behind a lot of people, and I could see it happening. You could see that those were the assets.
Was this when you were involved in politics as well at the time? Or?
No, I mean, I've been involved in politics a few times. Actually, it's funny, people say that you learn a lot more from your mistakes than your successes, so I must be an expert on politics next. I've lost three out of 3, so obviously I must really be smart in that space. But no, I mean, I think that you could just sort of see, because I could see that wages, I could see as owning businesses that wages were not going up at all. And all of this with assets saw our values going up, because with low interest rates, real estate prices go up, stock prices go up, bond prices go up. Those with assets were getting richer. Those with labor were not getting richer and were struggling. I said, this is unsustainable. And I was, I'm in it. On top of that, with what was happening with technology and AI and machine learning, and how that was driving people out of the worst workforce and would cause some big disruptions. So I started a nonprofit, and we've had some really stimulating conferences in which we brought together some very smart people, with Ray Kurzweil, Tom Friedman, and Larry Summers, and Tony Blair, and David Cameron's been here. And they've all come right to this hotel, and we've had some Arnie Duncan, the old education center. I mean, the list goes on. Super smart people convening together to really talk about the future of work. Again, as I said earlier in this interview, I have a personal experience with what can happen to somebody when their work life changes because of my dad, and I'm very sensitive to that. And I have friends, honestly, who are highly educated and who have been marginalized and lost their jobs and never gotten jobs again. I mean, if you lose your job and you're in your 60s, you you're really gonna go get retrained to become a welder or something. Of course you can't do that. So, and I really think that we are gonna have a lot of disruptions, and we have a lot of work to do. So we talk about that, and we talk about education. I don't know if you know that we started a school in West Palm Beach.
Oh, wow.
We basically I have 3 young boys, and we were frustrated with the private and public school options, so we started the Green School. And if you ever here and want to see it, we'll be happy to take you by. It's we're up to just under 130 kids, pre-K to 8th grade. And that school really embodies what I'm talking about, in that we want our children to develop a love of learning, because we realize that kids today who are going to graduate 15 years from now or 5 years from now may have 5, 6, 7, 10 career changes, and we have to constantly learn and relearn. They can't hate learning. They have to love learning, because they may have to learn new skill sets throughout their lives. And we've also have a focus on getting kids digitally fluent. They start doing coding in kindergarten, like coding exercises, all the way to building robots in the 5th and 6th grade. And we have an emphasis on teaching the whole child. So we have mindfulness and yoga and dance and art. And we've really tried to create, and it's a nonprofit school. My wife and I have funded it 100% ourselves, and we give financial aid, so kids pay what they can afford to, what the computer says they can afford to pay.
Yeah.
And it's 30-40% get financial aid. And it's been very fulfilling for us, truthfully, as you can probably see from how animated I'm getting.
Yeah. So how do you think we're going to resolve this rich-poor divide? Because it is not getting better. Yes, there's some marginal wage growth, late cycle wage growth that we talked about, but at a structural level, we've still got a huge problem. And the Fed injecting more liquidity and stock prices exploding higher, and your Apple shares got 35%, right?
Apple's doubled in the last year.
Yeah, it doesn't help the average guy, right? So how how do you see that resolving? You know, you're getting all these people together, they're talking about it. Are they talking about it? Is somebody thinking, I mean, because you've got Trump on one side, you've got Bernie Sanders on the other. That's how split this is becoming.
Right.
Somebody's going to have to find a solution somewhere, because if not, there's going to be more trouble.
We know that the Bernie Sanders socialism doesn't work. I mean, you know, as they say, certainly in socialism, the poor will be richer, but you're not going to make the poor richer by making the rich poorer. And basically, you have to me, I think the first thing is education. I mean, that's like that's the absolute no-brainer. There's right now in this country, 14% of Americans are illiterate. Now, if you're illiterate, it's not it's not about an income gap. It's about an impossibility if you're moving forward. It's virtually impossible. And we've really failed in our education in this country. I think that's the first thing. And I think that because you can't even be as happy if you're not educated. Because even if we created a society, that people talk about where you have, you have unlimited resources and people only have to work 20 hours a week because you figured a way to make your food more efficiently and your housing, your 3D printing housing. You just don't need people to do stuff. If you're not educated, how are you going to spend your life? You're going to do opiates, or you're going to do, you're going to do drugs and drink. So I think being educated gives you the opportunity not only to do better, but to enjoy and to thrive in your life. And I think that, there are great examples of successful educational improvements in America, in states like Massachusetts. New Jersey actually has gone from 35 to 3 in the country in public education by doing a few simple things. 2 years of pre-K for every child. Because like in a lot of the states in the country, these kids don't even get any preschool education at all, hardly, and then they show up at kindergarten, and they have a multi-million word vocabulary deficit, and you start behind, you stay behind. And I think we're really failing our children in this country, and that's the first order of business. If I were the President of the United States, that would be my number one priority. Get our kids educated competitively, because if they're educated, then at least we can compete with whatever there is in the world. And then how do you deal with with solving the issue of jobs for everyone, people feeling good about their upward mobility? A lot of that to me is a function of where we are in our cycle. I mean, people don't talk about this much, but my grandparents, like most people my age, came from Eastern Europe or another country. They were poor. Everyone was poor. Nobody came with any money. They came with a shirt on their back and a dream. And their only dream, my grandparents, was probably that my parents would be able to have food on their table. Nothing more than that. There's more than they had when they were in Eastern Europe, and maybe a place to sleep that was safe and clean. And then what did my parents want for their kids? They wanted their kids to be able to have every opportunity of all the other Americans who'd been here for generations. And so they fought hard, worked hard, so we could go to good schools, and we had great public schools as kids and great colleges. What do we want for our kids? And as it goes forward, what the level of expectation keeps getting higher and higher. And no one talks about that, but from my grandparents' generation to my kids' generation, their level of expectation is much, much greater for the kids. And meanwhile, what's happened is when my grandparents, after 2 world wars, we had destroyed the industrial complexes of our competitors. So we were this global superpower with unlimited numbers of jobs and opportunities when people's expectations were here. Now we're in a very globally competitive economy where we have to fight with much hungrier countries around the world, and their expectations are here. And so you say, well, how do you fulfill their expectations? It's a lot harder. So I think the first thing is get our kids educated so they can be competitive globally, and then, just try to figure this all out. But it's going to be a tough challenge, and I think it's the issue of our time.
Yeah, I think it is, and I think politics will remain pretty volatile until we figure out some of this stuff. I think that's that seems to be a part of our future that we're dealing with, and it's across all the Western world. And a lot of it is the transition of the baby boomers. Your typical the baby boomer generation of the baby boomers. That generation and the impossibility for the younger people to be able to afford even the housing.
Yeah. But I really believe we'll figure it out. I mean, it's interesting. Whenever I get pessimistic, I always think of our friend Warren Buffett, who we've got to know as members of the Giving Pledge. And we're sitting around a table with him recently in June, or in late May, we're talking, and somebody said, Warren, has it ever been this bad? I mean, the antagonism and the divisiveness. I mean, and he said, too. They said, I've lived through 15 presidents, 14 I invested with. He said, 7 Republicans, 7 Democrats, and there's no place like America. The whole world wants to come here. Don't bet against America. And then he said something else interesting. He said, I'm 88 years old. 3 of my lifetimes, which is 264 years, in 3 of my lifetimes ago, there was nothing here. It was dirt roads and Indians and cowboys riding around on their horses. Look what this system has done here. Look what we've built. And the same you could say for the European countries and the whole Western world. And so in the end of the day,
it'll figure itself out.
Yeah, the ship will start to drift a little bit, but we always ride it. And I think we'll figure out these issues. And this system works. And if we just stay with our system, there'll always be people like me who are aggressive entrepreneurs out trying to create and build things. There'll be other people who are more mellow and just want to make a living. There'll be other people who are creative and artists, and there'll be people like you who are trying to build, your journalism, your media thing,
business, yeah.
Media business. And I think I think we'll get through this just fine. So that's my view. I don't know.
Jeff, that's a perfect way to end. Thank you ever so much for a good, optimistic ending amongst all of that.
I really believe it.
Thank you.
Thank you.